Welcome.
Thank you.
Yeah, thanks.
Mark,
Glad to be
pleasure
back in
having
the
you.
big city.
Yeah. So home is where?
Neighborhood.
Yeah.
By the way, great place.
Oh, this is a cool place.
Very cool.
We have the Lower East Side has a soft spot in both of our hearts.
It's I haven't been here and probably since pre-COVID.
Yeah.
And it's rebounding great.
You know what's funny? We'll talk to a lot of New York real estate professionals, and my favorite question for them is like, how often do you get down here?
Yeah.
Almost never.
Almost
they
never.
live blocks away.
Spot on.
Yeah, this is like
Spot
the
on.
trendy epicenter of town.
It is.
I don't know what it's the epicenter of, but not broader New York, I don't think. Yeah, but Mark came up from DC.
That's
which
right.
we're very thankful for. And you're a DC lifer.
Correct. Born and raised, undergrad, grad
By the way,
school.
that's a rare thing. I found
Very
out.
rare. Very rare. Yeah. Because
It's
federal government, everybody transitions in and out.
It's probably the most transient city in America. But you're Arlington, you said.
Correct.
So were you always North Virginia?
Correct. Never crossed that river.
Never crossed the swamp.
That's like the thing. As a Maryland guy, you don't cross the river to the Virginia side. Virginia side, you don't cross the river to the Maryland
It's true.
side.
And even more
You remember
rare.
that?
Yeah, even more rare is to be like from the actual city of DC. I don't think
That's
I
right.
ever met a single person who was
Born
from
in
the city.
Georgetown
Yeah,
Hospital.
right.
Yeah,
right.
Like
There you
nobody
go.
ever grew up and was raised in Logan Circle or
Dad, I was not.
Yeah. So
Well, let's talk about. Well, obviously, we want to talk about KBS because that's one of the largest. I'd say one of the largest privately owned office companies in the country.
Correct.
But before we get into that and your role there as CEO, let's talk about your background, which we were kind of talking about earlier, and how you got into the business and came into KBS.
Sounds great. So I started many moons ago, graduated from GW, looking for something to do and got into real estate. Family was in real estate. Had an uncle who's a large developer in the Northern Virginia area. And obviously Northern Virginia had a lot of great developers. We were talking about that earlier, JVG guys, Boston Properties, et cetera, who made big headwinds there. A gentleman named Bob Kettler, who did multifamily and was partners with my parents and some stuff and with some of my uncles. And just liked it a lot. Was leaving GW, wanted something to do. Guy comes up to me and says, "Hey, you want to be a resident manager?" A resident manager, what's that?
This is in your dorm, or this is
apartment.
Okay.
You manage apartments. Like somebody has to get in at 2 a.m. They knock on your door. Right? You got to let them in. They got to pay their rent. They slip it under your door. Well, what do I get? Oh, you get reduced rent. So I was like, it's great. More money to spend on beer and everything else, right? What's not to like?
Do it.
So I got involved with that, did a little bit of that with my family as well. Never work for your family, right? I'd say that jokingly. I could tell my dad 2 + 2 is 4. He'd look at me like it's crazy. Alex come up and tell him that, and he'd be like, "You're a genius." Right? How did you know that? And so anyway, I did that for a little bit. Then went to a Dutch company called Savage Fogarty. Largest client was a group called ING. ING was making big headwinds coming over from the Netherlands, wanted to get in the real estate business. And they decided to buy a company called Clarion Partners, which used to be called Jones Lang Wooten Realty Advisors. And a little beyond that, I went to work for them and spent almost 17 years with Clarion, ING, and then went to, it was 11 years ago, came over to KBS from there.
Got it.
how did that opportunity present itself?
So looking for change. We were looking to get in the non-traded REIT business at KBS.
Yep.
So I started, at Clarion. So I started studying companies. KBS is one of the largest, raising $4 or $5 million a day from private individuals who wanted to invest in real estate.
Wow.
And Peter and Chuck, I'd met Chuck several times at various events, speaking engagements, et cetera. We had a mutual client that we represented, the state of Michigan retirement system. So I met him at a party for one of them, an opening party for one. Clarion and it's an interesting story real quick. Clarion and KBS both represented two sides that owned Edens and Avons, which was a large retail developer you guys probably know of or heard of. And they were the equity behind them. So we were at a party for them where they were having their new office opening. And, we met Ed there and Chuck was there and we sort of talked a little bit. And then I started investigating, how are you guys raising so much money so quickly? And it was really reputation, right? And they were doing a great job and they had a great conduit. They had great relationships in the registered investment advisory business. So Clarion, we were going to do that. We were going to launch it. We had ING's backing, and we started to look at that. And then lo and behold, the GFC happened. Model changed a little bit, obviously, for everybody. ING had to sell Clarion, too big to fail. A group of partners, I was one of them, went and bought the business from Clarion with a group called Lightyear, and decided it was time to go do something else. And Chuck had a great opportunity for me and said, hey, would you like to come and run the whole eastern part of my company? Very entrepreneurial, very sort of self-rule. I'd say that, if that makes sense, if you know what I mean, right? So it was a great opportunity, and I went and did it, and it's been phenomenal.
So KBS, I guess, are these initials?
Correct.
That's what I figured.
Yeah.
Okay. So
Don Cole,
Yep.
Peter Bren, Chuck Schreiber.
Got it. And Chuck is the only one of the initials still
Correct.
somewhat involved, mostly in capital raising, I'm assuming. And
he's our chairman.
Okay.
Yeah. So he's still actively involved in investment decisions, talking to separate account clients.
Okay.
Yeah. Very, very much involved.
So,
office every day. Comes in the office every day at 7:30.
Really?
That's great.
Got it. Well, I mean,
That's rare.
Tell us when you started, where was KBS focused on, and where was most of the equity at that point coming from as well?
Great question. So really, it was all in the non-trader REIT business.
Okay.
So a lot of people don't realize KBS also had about $1 billion multifamily REIT that they raised money for as well. So that matured. Sold, they decided, let's not do multifamily much anymore. Because if you look at sort of like the NCREIF index, right, that all of us in the real estate business look at, the 3, 5, 7, 15-year, office was number 2, only behind one asset class, which was industrial, right? So like, well, why are we doing this multifamily, right? Well, they got out of that multifamily business. Of course, multifamily's gone to the moon, but it still has its challenges today, and we can talk about that later.
Yep.
But so they focused on office. Right. And they focused on those and really specific office markets that aren't necessarily always main and main, but had strong fundamentals, whether it was a work lifestyle, educated workforce, great location, great access to public school systems, so families were locating there and workers were locating there. So we were raising money doing that. And when I got there, we just launched our third REIT and office specific. We also had separate account money, state of Michigan, as well as Middle Eastern client, Sovereign Wealth. And we were focused primarily solely on buying existing office. So I came to Chuck and Peter with a little bit of a idea, and Peter at first told me I was crazy, and then Chuck said, well, maybe he's not that crazy, and it was, let's do development. So we did some industrial, we did multifamily. Our multifamily projects just killed it for our clients, industrial as well. We're in the process of selling them now, and the IRRs are, I remember I saw one of your podcasts where people are like, oh, if anybody ever tells me, oh, you can get a 30-something IRR, you're crazy. And they're right? We tell our clients, hey, we're going to make a 2 multiple and a 22% IRR.
Right.
Well, it's going to end up being 40 plus, right? Because it was just the right projects, Sunbelt, Texas and Dallas.
And how long is the hold period for these to hit those? IRRs?
Basically 7 years, roughly. Anywhere from 5 to 7 when what those have been now. The industrial a little bit longer. But yeah.
And are these in closed-end 7-year funds each?
They are all separate accounts.
Okay, all separate.
Yeah. So we are looking now at fund business, and we'll talk about that again later, to get into that, or doing more separate account business as a non-traded REIT business has evolved, right? It had its challenges. So, like I said, they were raising $3-5 million a day in the non-traded REIT space. And then, something came along, a company called ARC, which everybody talks about, doesn't really want to talk about. And that created a black eye for the industry, right? And then you get a company like Blackstone who comes in and it's just game on. And now you have LaSalle and Clarion's doing one. And so they're all starting, Starwood, they're all starting to pick up again. The question is, can anybody ever compete with the
Right. Let's take a step back because there's a lot there to unpack. So let's go into the different structures.
You can kick me under the table.
No, I love it. I love it. This is great. The problem is there's only so much time. We want to cover as much as we can without going too fast. But let's just take a step back and talk about the different structures that KBS started out in and where they are today. So we'll talk about the private REIT space, non-traded REIT space, any sort of public markets that you guys are in, which I think it's all mostly private.
Correct, all private. Yeah. With the exception of something we launched in Singapore.
Okay.
So
well, let's
so
talk
originally
about,
KBS started solely in the separate account business.
Okay.
And Don Cole, Peter Bren, and Chuck Schreiber would pound the pavement. They would fly all over the place.
So that was still institutional.
Correct, purely institutional.
Okay.
Places like IBM Retirement Account, right? State of Michigan, Texas Retirement System, Illinois.
And they already had a track record of some sort to be able to track that, or?
Well, Peter was a Lincoln guy. He went out and started the Lincoln office in Europe.
Okay.
And then said, these guys are making, why am I not doing this myself?
Right.
Don Cole was a huge developer in Southern California.
Okay.
Chuck was a broker. And so they got together and formed a company. And then they went around, and Peter said, you know what I don't like about this business is I'm a people person, right?
Mm-hmm.
I like to deal with the individual who I'm ultimately delivering my results to. Well, in this business of separate accounts, a lot of them use an intermediary, right? So they're using trying to remember the name of some of these companies that basically they're consultants, right?
Mm-hmm.
Townsend, et cetera, who will advise a pension fund on who they should pick.
Yeah.
Well, he didn't like that. He's like, I want to
take out the middleman. Yeah.
So I'm only going to do clients that want to do that. So he's very specific on who they would go after. And he forged those relationships. Well, his fees became more transparent and a little bit more tighter. Mm-hmm. He said, we should look at this non-traded REIT business. So they looked at it and they launched it and became hugely successful. And then they just basically started with solely office and multifamily.
Okay. And what years are these roughly? And I'm asking that because that business really took off over a certain period of time.
Yes.
And
so
it didn't used to be a thing.
About 20 years ago is when they really launched that business.
Okay.
And it really started to take off. And our average investor was $2,000 to $3,000.
Yeah.
Right. And you could sit around a party and say, hey, I own, see that building across the street?
That's mine.
I own part of that.
So from $2,000 to $3,000 a check, they were raising $4 to $5 million bucks a day.
Now, then the initial episode, right, called REIT 1, was raising about $1 million to $2 million. And then as they grew up, as they grew up, they started getting bigger and bigger. And then in REIT 3, the average investor size is $15,000.
Yeah. But that's one of the advantages of the REITs is to open the pool up.
Correct. And also it's, the issue is it's liquidity.
Yeah.
Right. So, but most of these people are doing it for a solid dividend play. Mm-hmm. And they had always delivered those dividends, 6-7% without a problem. And people enjoyed it, especially when interest rates were at, 2%.
Right.
Or less if you're in a savings account. 2 if you're a CD, if you're lucky, right? Back, call it 5 years ago, 4 years ago, when the Fed rate was in 2022, 25, 50 basis points.
Yeah. Okay. So
they went from that to raising that business. And then when the ARC thing transpired, we started going back into the separate account business.
Okay.
Right?
Can you explain that a little bit for the layman's for me?
Yeah.
So what was so sweeping about the ARC business that it started to transform what you guys were doing?
So how it transformed is people lost a lot of confidence in the business, right? So what ended up transpiring there, or the allegations that happened there were, hey, you're raising another fund and you're taking that fund and you're taking that money out and paying off the fund before it, right? So where as opposed to just selling everything that's in that fund and then liquidating and returning to shareholders whatever their value is, that wasn't perceived to be what was happening there, right? So that raised such a black cloud in that business where RIAs started questioning, like, is this really where I should be putting my clients' money? Now, you go in public markets, people would wake up one day and you look at, Janet Yellen's, she, scratched your head this way. Holy crap,
that's
the market's going in the wrong direction.
Signal.
Yeah, there's a signal, right? She's doing something. It's like the guy stealing third base, right? You're waving them off. So what's she trying to tell us? You didn't have that in the private REITs, right? Your real estate stood by itself. So when that happened, it just created some doubt in the business and how the business works and how to ultimately get liquidity, and can you get liquidity? And yeah, you can, but obviously it was what happened with COVID. It was a perfect storm for office REITs.
Yeah.
I mean, killed them if you look at everything that transpired the last 5 years.
Yeah.
Well, let's go into that. So COVID hits. I'm sure you're tired of telling this story, but it never gets old.
Like it was yesterday.
Yeah. So
kids come home from school.
Boom.
They shut it down.
Right.
What do you mean they shut it down?
Right. And you're thinking to yourself, I'm sure this didn't happen at first, but what the hell happened? Right. I mean, this changed everything. I mean, we have to talk about where office is going post-COVID, but we don't want to cover it too much because I think it gets covered probably too much, right?
Yeah, too much.
But let's just touch on it. COVID hits, everything shuts down. How'd you guys approach that?
So in several ways, right? Obviously, headquarters in California.
Yep.
Very aggressive.
Right. Worst place to be during COVID.
Correct. Unless you're in Orange County.
That's
Newport
right.
Beach, right?
That's
you
right.
go down there, it's like COVID never happened. It's
or New York.
Or
but
Texas.
Yeah, sure. Yeah.
Right? You go to Dallas, right? They never had
We were
COVID.
thriving in Dallas.
The Carolinas, somewhat on separate sides.
And by the way, I'm sure you saw it in a lot of your products because
Tons.
all over the place.
Tons, right?
Yeah.
I mean, we went from, one of our largest assets, Accenture Tower in Chicago, 1.5 million square feet. Accenture's U.S. headquarters went from, we're right above the Ogilvy Transportation Hub, right?
Mm-hmm.
A couple million people a day going through there to 2,000.
Wow.
2,000
Wow.
for almost 9 months.
Now, meanwhile, did you have something
unreal.
to compare that to how your properties were performing in
So that's where I was
Dallas
gonna go.
or
So
in
then,
Texas?
So then you go to Texas. It's like, okay, we had initially 90% drop. 30 days later, 70%.
Yeah.
Right? So they all started coming back shortly thereafter. Our office in Arlington is a good example. Our employees there were for 45, maybe 40 days at the most.
Yep.
Weren't coming to the office. And they're like, okay, y'all need to start coming back. And they started coming back. And so now, granted, other companies weren't necessarily that active.
Yep.
Technology in particular, those were the ones that just, to this day, is now starting to come back to the office, as we all know. But yeah, I mean, you look at Florida, the Carolinas, Texas, those, even I would argue, Phoenix was a little bit behind lagger, but
in between.
In between. Those estates, those employees and those companies are coming back relatively quickly.
But separate from that, what we really care about is leases.
Yeah.
Right? Are you getting paid or not? And so how much did that actually impact things?
So it's funny because you had probably in our entire portfolio on the office side, right around 10, 12%. I can't remember the exact number, but it's right around that range.
Yeah.
Who came to you and said, hey, I'm having issues. I want to talk to you about my lease. They were all smaller companies, right? Lost contracts or whatever. So we would work with those companies, right? I didn't want to say we became a bank, but basically we'd say, okay, we're going to help you out. And we did it with our retail tenants, right? Retail tenants as well. In Accenture Tower, every retail tenant who had an issue, the only one who didn't, believe it or not, was Amazon Go. Second location they've ever put outside of Seattle was in our building, right? They never called us up once.
Yeah.
Everybody else in there, the other, call it 295,000 square feet of retail, called us and said, hey, we need a little bit of help.
I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Graysteel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com. That's funny because Amazon Go has tanked, really, hasn't it? It never really took off.
Which is surprising.
Right.
I don't know. There's a location by me on 53rd that's killer.
No kidding.
Yeah,
Grace
ours
uses
in
it
the Accenture
constantly.
Tower is, it's crazy going in there.
Yeah.
I mean, it's
got to be so location
Really?
specific. Yeah,
I mean,
it's
they have these
grab and goes.
Amazon grab and go things at Love Field at the airport in Dallas,
Right.
and I never really see anyone go in there.
Really?
Yeah, I don't know. I mean, Call me old fashioned. Something about just actually going to a real
both sides of the
real
spectrum.
cashier.
A real cashier. That's what does it for you. That's why you shop.
No, you can't. You can only bring
I love waiting in lines.
Oh, and you can't tip either. But anyway.
No. Tips are accepted everywhere.
Right.
Tips are accepted
now,
everywhere.
Don't Jack started carrying a little iPad. He'll give it to you at the end.
No, a little coin purse. And just.
Sound like my wife.
Yeah.
Why did I got a tip for somebody just handing me a bottle of water out of the fridge?
It's absurd. And now they make it, have you noticed this? They make it hard to opt out of the tip.
Yes, that's right.
Sometimes and then you feel weird because you go, which button?
Where the button I got to push?
Where's the cancel button?
So true.
Nobody wants to be that There's no easy button on that.
Yeah.
So going back, what was interesting is we went to these tenants came to us and we said, okay, here's what we're willing to do. Mm-hmm. So we're going to put on the back end of your lease, we'll waive 6 months of rent. We'll put on the back end of your lease, but you'll extend your lease by 6 months. Right. Yeah. So people are like, well, why would you do that? It makes no sense. Well, we need these tenants, right? For all our stakeholders to benefit, whether it's the bank, our shareholders, or even our tenants, right? We all need to work together. So, but what we did in doing that is that when you went to the back end of your lease and you extended it 6 months, well, if we're getting 3% annual escalations,
you get the escalations,
and you're 5 years up, we just made 15% on our money.
Yeah.
So, and if it's a good business and we know they're going to be there, and that's what we did. We'd analyze the business to make sure it was one that was going to be there. Did all of them work out? No. But I'll tell you less than 2% did. Mm-hmm. And the 2% are solely on the retail side. The office tenant is less than 1%.
Yeah. Interesting.
Who didn't end up making it through COVID. So it was great for them. It's great for us. And by the way, now you've created a relationship.
Yeah.
So,
do you think that came down to like geography or mix of tenancy or both?
Yeah, that's a really good question because nobody's ever asked that. If I look back at it and I look at the list of tenants, I would tell you the theme that was consistent: contractors, people who had in the contract consulting type kind of business. The smaller ones were the ones that had the most impact of COVID.
Yeah.
Because those contracts were put by the wayside or they were canceled.
Right.
That makes sense.
And then on retail, it was just everybody.
Yeah.
I mean, because people didn't want to. I mean, remember how crazy it was? People were sitting there spraying bleach on boxes at the front door.
I know. I look back at like wiping boxes and it's crazy.
And by the way, living in DC, like your neighbors are everybody you can imagine.
Yeah.
Right?
Yeah.
CIA, FBI. My wife was 23 years of Secret Service, right?
Your wife is in Secret Service?
She was for 23 years. She retired pre any of this stuff that's been going on. So don't hold that against us.
No, but that's so. Was she on detail with someone physically?
The only time she had to do a detail was after 9/11. She did Dole, and she also did the Olympics out in Utah. She had to because they had heightened security, so they needed every resource they could to go out there and do it. So, but my point is like they were talking all around the Beltway. This isn't something that happened in a market,
right?
No one wanted to listen, right? This is a lab, right? Like this is
totally. We could go through this.
You can make 20 podcasts.
Don't get us started.
Yeah, crazy. So
and still, no one's held accountable. But anyways.
Anyway, my point is that like you didn't know where the end was. Yeah. So when it's people are canceling these contracts and tenants aren't using their space. They're like, am I just going to shut down? You don't have insurance for this. Right. So if you didn't have a decent balance sheet, you're basically either I got to get my people back to work and then I got to figure out how we're going to continue the business, or I need some help from my landlord and figure it out, or I just file.
All right. Well, I think this is a great interlude or transition into. I want to talk about interest rates because that certainly was an aftermath of COVID, and we're still kind
perfect
of
storm
dealing with
on
that.
office.
But you're talking about we just had that during COVID, right? Where people weren't coming to work, they're not going to the office anymore. Now we're back to work, right? Return to office, and this is kind of the hot headline in the news these days, particularly in DC, right?
Yeah.
So tell us what's going on with that,
or at least what you're seeing.
Yeah. So I'm seeing a lot, right? My wife went from there, and now she's Inspector General's office, another government agency. So it has been refreshing as an office owner, right? Who's, I'd tell you 85% of our portfolio is office, right? The rest is industrial and multi, and retail. And if you look at the response that has happened with the federal government going back, it's to me, has provided two things. One, I'm shocked at what has transpired in government real estate over the last 24 to 36 months.
Mm-hmm.
And then number two is what's going to happen to the inventory of government stock that they didn't take care of because they didn't think people were coming back to the office, right? So there's one agency located out in Herndon Market. Their lease is up. They occupy the entire building. They have specialized space, cells, interrogation stuff, whatever. Their lease is up in September.
Yeah.
Hasn't been renewed.
You can't repurpose that except for like a haunted house or something. I don't know.
Yeah, but you're a landlord, right? So it's owned by, it's privately held, right? It's a lease. But the lease is up in September.
Mm-hmm.
Because they were like, oh, well, we're not going to have people come back to the office.
Yeah.
So there was this mindset, right, going around. And even my wife was like, oh, yeah, they kept saying, we're probably never going to go back to the office full time. Yeah. And how, right? I mean, you look at anything created in the history of anything, creation. It's not just one guy sitting there or gal doing something and says, oh, I made this microphone or I made this great coffee mug. Yeah. It's collaboration. Yeah. And you can't, how many times did you sit there and say,
totally,
Alex, I can't hear you. You're muted. Alex, hey, you're muted. And you keep talking and you're like,
yeah, there's no substitute to being in person.
Sitting here right here, having these conversations.
This is why it's so important for us to have people.
That's right.
And I think you'd appreciate it as an office owner, but the whole idea of like the hybrid schedule, right? Yeah. All right, so now I'm in the office, but you're not in the office. How does that work?
Yeah.
Right. We're sharing an office. So one of the big things we saw coming back out of COVID, right, and the return to office, law firms, believe it or not, some of the bigger law firms that are clients of ours said, we're coming back to the office. I can't stand here and pay a first year associate $180,000, $200,000. He can't write a brief. She can't write a brief. She can't do an oral argument. Mm-hmm. She can't do a deposition. He can't do a deposition because they haven't learned it. I can't teach them over Zoom or, grading papers like a law school professor when they give me a written argument and I got a red line and send it back to them, but they still don't understand. We got to get back in the office. And oh, by the way, I don't want to share office. I don't want to look at Alex's family pictures on my desk. So we're going to have separate offices. So by the way, we may need more space. Yeah. And so now that's transpiring even in the government. The agencies that have come back are realizing, hey, we don't have enough space potentially here, or we don't have enough parking, or, whatever. That's going to be something that's going to have to be dealt with dramatically quick.
But at the same
time, we're reducing the force.
That's what I was going to ask.
Right.
About,
And so the question is how quickly can you come to a resolution? Right. Like I love the whole chainsaw gig that Elon did, but at the end of the day, agencies got to sit down. You got to say, I'm going to hold you accountable. It's your responsibility. You run it. Yeah. Tell me what you need and tell me how you're going to cut. It's the old Jack Welch thing, 10% of your workforce, right? Yeah. Doesn't work, get them out the door, right? Do that every year and you have the best of the best. That's never happened, right? People came into the government saying, I'm just going to be there forever and I don't have to worry about it. And then, that transpired. So as we're doing that, right now this new plan came out. You guys got to submit plans by a certain date. I think the date was last week, right? So now these agencies have all submitted plans. So the question is going to be is how quickly can they adapt to those plans, whether they accept them or don't accept them, modify them, and then be able to accommodate whatever that workforce is. And, people joked about USAID when they were taking the sign down, we're going to put up another agency sign because that other agency dire need of space. Yeah. So some of that's going to happen. It's just going to be the hard truth and fact about it. And I think DC at the end of the day, you're going to see, I'm just going to call it 800 basis point increase in vacancy rate. I hate to say it.
Yeah. I mean, DC is plagued by
28% of the federal government. I think.
Yeah. And that is definitely the leading factor. And then there's just so much aging stock. Yeah. It's been battling aging stock and forever. It's also the land of REITs and who's better at optimizing than REITs, right? So I've seen everybody rebalance their portfolios.
Like from experience.
I might have seen it. I might have seen this playbook once, right. But for 5 years at least, even definitely before pandemic, everybody started to right size their office balance, right. And there was a time where a GSA lease was like a gold brick. It's the greatest thing you could get.
Well, I mean, you were talking, right, a little bit about return to office, and I mentioned, we talked about the government, but, technology companies were just as bad. Yeah. I mean, they waited forever. Menlo Park, you have huge sublease that happened there, right? And so from Facebook, they're taking, I can't remember the square footage of what they're taking, right? But it's a sublease that's happening out there. And my point is that, so they're ready to come back to the workforce. They over allocated themselves, meaning Facebook, on space. So they're going to hedge it a little bit. They're going to have somebody come in and sublease a couple 100,000 square feet, right? So it's good that those folks are now starting to come back to office and making that push, right? Down here in New York, I mean, look at all those leases that were done with Microsoft, Amazon, and those buildings. So was it the old Bloomingdale's building? Is that the one that was done?
Here in New York?
Yeah, it got bought by
large Bergdorf's.
Yes.
No, Barney's.
Barney's.
I knew I was on the B.
And so, again, perfect redevelopment play, right? And going to move their people in there. That now has taken what should have been 2 years, is now turned into 7. But it's going to happen, right? Mm-hmm. And so you're going to start seeing it take back. Do we ever get back to where we were? I'm the undying optimist like Ronald Reagan, right? So I think you do. And the reason I think you do is because you have stock, as we just talked about, that's so antiquated that this shouldn't be office anymore. And that's going to be reused. Everybody keeps saying, it's going on multi. I wouldn't go crazy like that.
I think there's a lot of groups that are very bullish on office because there is a dislocation, right? And so the GSA, for example, going back to that they're going to be doing, there's multiple things, right? There's going to be some leases that are going to be broken or getting out of, but there's also going to be some actual physical assets that the GSA owns that they're probably going to get out of.
Correct.
As well. And so what does that do to the office stock?
I mean, you used to go DC and call it 5 years ago, mm-hmm. right? You'd buy a building at $600 a foot and rip it down.
Yeah.
And spend $800, $850 and build another building, and you're getting rents, call it in the high 50s, $60 triple net basis, mm-hmm. and you're getting a rock of, call it 6-7%, and you're leveraging the money at 2%.
Mm-hmm.
Right? I mean, it was, now you can buy well-leased buildings in downtown Washington, D.C. at, that type of number. I mean, north of it, but call it, $900 a foot.
Mm-hmm.
So, and that's pre anything getting on the marketplace as far as federal government is concerned. Now you look at some of the buildings, right? Like, what are you going to do with the interior building? Or what are you going to do with IRS? I mean, it's like, the building's 4 stories tall and it's made out of granite and it's got stone columns out front. Unless somebody wants a great mansion.
It's kind of, it's like a near-term double-edged sword. And near-term, it sits vacant. It puts the economic pressures on the vacancy rate and all that other stuff. But then it gets sold for land. It gets demolished. All of a sudden, your vacancy rate corrects itself and the market looks a little bit better. And I feel like that happens so fast that everybody starts to rush in, and then it just adds additional pressure.
And I do believe there's a lot sitting on the sidelines, right?
Yeah.
People are starting to scratch their heads, right? Recently, we just got done doing, in the last 12 months, $1.3 billion of debt extensions on sole office, purely office. And that's just in one fund.
It's very impressive.
And we did another $700 million in another fund, right? And so $2 billion of refinancings in the last 12 months.
I've seen firsthand how the right platform can make all the difference for advisors and their clients. With decades of collective experience in investment sales, debt placement, and equity placement services, Graysteel has built a culture where collaboration, relationships, and excellence power results. Backed by concierge-level infrastructure, proprietary technology, and an entrepreneurial mindset, the firm enables professionals like myself and our team to deliver tailored solutions, precision-driven pricing strategies, AI-enhanced insights, and exceptional value at every stage. Discover how top professionals are scaling their business and continually unlocking new opportunities for their clients at graysteel.com. And what type of leverage does this look like?
Well, so the great question, right? So the benefit to us is we weren't a high leverage vehicle, right? We maintained ourselves, prided ourselves 55, 60%.
Okay.
Right. So when you have a correction of valuations that have been impacted, just office, right? 25% national average, right? You go to locale, some of it's 40, some of it's 10, like Preston. Or even if you go to places like Northern Virginia, great office assets in like the Clarendon market, some of the best in Clarendon, Ballston, that market. 10% impact, maybe 15. So, but overall, 20 some odd percent, right? Almost 30. So with us, the benefit is you're not negative on your leverage, right? So we lost liquidity, obviously, because we had all this excess liquidity to draw on that you can't draw on. So you got to have those conversations. But we went from an average interest rate of, call it 3% to 7 to 8.
Yeah.
Like that. Now we can cover it. It's tougher, obviously.
Yeah.
The benefit is like REIT 3, for example, the overall portfolio there, great quality of assets. It's 84% leased. And that's with, stuff in Minneapolis and the Bay Area and San Jose that are, ugly. But, downtown Chicago, if I told people, oh, what's Accenture Tower leased at? 98%. They're like, wait, you have a building in Chicago that's 98% leased? Yeah, we're beating people away from, if we had more money, we could lease it to 100%. Yeah. But we won't get paid for it because, those brokers, they never want to advertise something that's 100%. You can't get it past 90, right? 92. So you're seeing it all over the place. But yeah, to go from right around a little under 3% to 7 to 8 is huge. Now, if you don't have that cushion in your LTV, because who knows what valuations are? Right. It's funny. I had one. You could say this without giving any names. We had a loan that had 2 participating banks. They didn't believe the Asian bank's valuation, right? So it's done by big reputable firm. We don't believe that. We're going to go get our own. We think yours is way too high. Okay, they came back. We hold off 3 weeks. Well, so what's the valuation? It's actually higher than the agent bank. So now we're like, oh, great, you're going to give us more money? Well, no, we're not doing that. But it just goes to show you that, and 2 huge firms that are in the real estate business, right? I don't know if we like to plug people, but, CB and Cushman, right? Sure. Great valuation groups. And they are not even close to each other. Yeah. Because no one really knows. The liquidity, right? Well, if you take something like, we just sold Preston Commons. And that's the other thing we're starting to see. That asset was sold to a corporation. So corporations with big balance sheets, and we're not talking about the tech ones. It's an energy company, right? Yeah. We want to control our destiny. We need to expand. We're going to grow. Why not take advantage of something that, oh, by the way, I would have paid a 5 cap for 5 years ago. I could buy it at a 7. So 6. And 6. Is that what you're seeing right now in the office market? Obviously, it's as far as it's market acquiring, specific. As far as acquiring. So yeah, great question. Yeah. So very, very market specific. Okay, right. So Dallas, Preston, in the area, phenomenal. What type of cap rates is that generally right now? Mid 6s. Okay. Places like we're selling an asset right now up in Leawood, Kansas, AMC's headquarters, very 100% leased. 100%. It's a mixed use project. It's like a town center concept. 69 confidentiality agreements, 17 tours so far. It's been on the market, call it 3 weeks. Okay. Just sold or getting about to go into contract on, well, here's a comparison, an industrial project in North Carolina, 114 confidentiality agreements, 37 offers, pared it down to 18 and pared it down to 5. The last 5, every one of them is a household name, huge institution. Values $150,000 apart between those 5. Wow, $150,000. I've never seen anything like that. Super tight industrial, right? Now on the office side, Preston, when we went to go sell that, we had 4 groups that were all within $750,000 to $1 million of each other on a $100+ million transaction. Yeah, 2 of the 5 willing to pay all cash. Balance sheet players. Are these value add plays, or they're just going to? Well, two of them were companies who they're moving in themselves. They're in that market already. Yeah. There's a role that's coming up, so they can sort of grow into that if they want to grow into it. And then the other 3 were opportunistic type kind of buyers, high net worth families. We've seen a lot of that as well. Mark, do you think it's a testament from some of these corporations? From my point of view, Amazon, Facebook, like they're taking advantage of it. And I say them specifically because in New York, Amazon bought the Lord & Taylor building. Then they signed a 300,000 square foot lease across the street. Right. So they're starting to take advantage of this. One of the largest office
on a price per square foot transactions. I think it was a Japanese company that bought in Chelsea, but it was at like $1,400 or $1,500 a foot for a building that they're already in. So when I'm looking at that, that's a signal. Oh, these guys think it's cheap relatively to their history. This is the cheapest they're leasing for. This is the cheapest they're buying for. Same for Bloomberg. Bloomberg was signed for another 20 years at 731 Lex. So what do you see that as the same signal, or is there anything that we're missing here?
No, we do, right? I mean, you look at historical, right? I mean, this is every time there's been a crisis, there's money to be made in real estate, right? And you can go back to when everybody said malls are never going to exist again. And, look at what happened to GGP's stock price. Ralph's gets bought by GGP. GGP goes in the tank. And then all of a sudden, I have 2 kids, right? Do they shop at the mall? No, but my youngest goes to the mall, meets friends, they go have dinner, and they'll go, whatever. They wander around stores and do the like, and they'll end up buying some things. But like malls are starting to come back, right? Office. So we experience, more than anybody's share of downturns than any other type asset class, right? So in office, you had, the bust of the 90s, right? We had, everybody forgets the dot-com bust because they took so much space. And you had 9/11, which, didn't impact office everywhere, but New York, DC, hammered. I mean, because it was their target terrorist central, right? Bullseye. So those markets, I remember, it's amazing what was going on in New York and DC after 9/11. And then you have the GFC that happened, and then now you had a combination of COVID and then rates going in 16 months from up 5 to 525 basis points. Yeah. Right. And so the perfect storm. Now, the good news is for a guy who has 80% office is those rates impact everybody. Right. And they're impacting multifamily, impacting industrial. The only people that haven't impacted is data centers, which is crazy. Another crazy conversation to have later. But as you look at that, right, and the impacts of it, well, what it did greatly for office is there's hardly any new supply coming at all. Multifamily still has a bunch of supply coming. Yeah. And you're starting to see it, like, for example, our projects in Raleigh, Carolinas, at one point in time, we were seeing 9 to 10% rental increases every year. Right? That's one of the ones that we're going to sell, and it's going to deliver a 37% return and a 2.28 multiple, right? But now, last year, negative 10.7%. Because there's so much stock. People were like, oh, it's Raleigh. Everybody start dumping in product. But the good news is that our occupancy rates have remained in the low 90s, right? So concessions come up a little bit. But so as you look at it, certain markets and the impact that construction costs, and then couple it with the price of borrowing money, office has had the hugest impact on that as well. Yeah, complete standstill. Yeah, nothing coming on. I mean, there's a little bit here and there. So I think that bodes well for if a company really needs space. And if you're a big company like an Amazon or any of these large energy companies or any technology company or any banking, remember for the longest time, a lot of them owned their own office space. Wells had that huge building in San Francisco. Yeah. Ended up selling. Now, San Francisco is different. I mean, there's reasons to sell and reasons to get out of San Francisco. Ultimately, hopefully it comes back, and it should. But my point being is that that's where the opportunities are. And I think that when you see corporations starting to step up, they're usually the last ones to start buying their own. Yeah,
so it's a sign.
To me, it's the strongest buy signal.
So for KBS, are you guys in acquisition mode?
So now we just got done with our debt. Yes, we're looking for opportunities.
That was probably stressful, I imagine.
That was beyond stressful.
Yeah. But by the way, $2 billion, that's a serious number.
That's only office.
Yeah.
That's
what was some of the big key takeaways for you? Like what helped you get it done?
Relationships. Yeah. I would tell you that it is. We sat there and there was no, aha, I got you. There's no, I'm going to hide anything. There is full disclosure. Hey, here's what we're looking at. Hey, here's your collateral. I worked for a bank at one point in time, so I could understand that. So when I sit down with the head of, whether it was Bank of America, Wells Fargo, PNC, UBS, U.S. Bank, you can have these conversations. I understand what you guys are looking at. And here's, your collateral, and here's why it's important that we should be doing this. Right?
And the good thing is you were pretty low levered to begin with.
Correct.
Going in,
but you're still like, okay, banks don't like doing,
right.
Depending on whose valuation you're looking at. Like the one example I gave you, they don't like doing 75%. If you look at the one valuation, it's 85. Look at the other, it's 69% LTV stuff, right?
Yeah.
No matter, they just don't. It's just not how banks, although everybody forgets, at one point in time, they were doing developments at 105% cost.
Yeah.
So they were financing your developer profit as well as everything else that you had to do into it. But again, after all those different cycles we experienced, right, it rebounded dramatically. So I do think that in these conversations, having the relationships with banks and being fully candid with them and saying, by the way, the second I can return shareholder money, I want to do that. So I'm not looking here, I'm not a fee guy, right? We're fiduciaries. So we need to return shareholder money. That's our most important thing. So if you want to tell me, hey, as soon as market recovers and I can sell this for a reasonable dollar amount, I'm going to do it. But don't tell me to sell it now at a distressed amount, because that's not the benefit of everybody.
Is it easier to finance on the REIT side or the separate account side?
Separate account.
Okay.
Separate account. And the reason why is because separate accounts, nobody provides guarantees, right? The REIT side, you could do a little bit, right? Like you'll provide some recourse carve-out guarantees. And they're minimal, 20, 10, 15, 20%. Well, right now, nobody wants to do that, right? But if you're a separate account, first of all, they tend to be low leverage, right? All of my separate accounts are the history, whether it's CalSTRS, NYSTRS, New York Common, Michigan, they don't like using, because it's another risk debt, right? So let's keep it around 50%. So, for a bank to be able to say, hey, I'm going to loan you on your building in downtown Nashville 50% of your purchase price. That's great.
Yeah.
Now, the refi is beyond difficult because you guys said it earlier. Nobody knows what it's worth, right? So buying something right now, there's debt out there, right? Believe it or not. Because, listen, banks, they have unprecedented amount of money right now. Look at all their earnings. And how do banks make money?
Giving it out.
Giving loans.
Yeah.
Right. So they want to do stuff. And they'll do it for office. It's got to be really good office. By the way, they're resetting the basis on the value. So they know what the value is. So they're not guessing it like a refi. So if it's CMBS, SASB, or even just a straight out bank loan, they're willing to do that on a brand new purchase because everybody's looked at it and everybody deems this is the market value of it. So if we do a 50, 60% LTV on that, that's great. But on a refi,
luckily the CMBS
that's the
market started to come back a little bit. So I think that pricing's more
dramatically too.
Yeah.
Yes.
Well, I think take a step back for a lot of our listeners and viewers. Look, they don't understand why no one really knows what the value is. It's interest rate driven, and it's also just uncertainty in the office space.
That
too.
and transaction.
And transaction. Right.
Yeah,
right.
Those three. Those are exactly the three ingredients and have no clue.
Is there, especially having seen so much office, and now you just went through a massive refi, I don't want to call it cycle, but for you guys.
I had more hair than you when I started it 2 years ago. Anyway.
But is there, the markets that you guys are invested in are so different from one another. What's making one market stronger than another? And there's the things like eds and meds. I get all that. That's why you're there from a macro level. But
I won't even go there. Right.
What's really uplifting certain markets versus other markets?
Well, I think it's not. Well, markets in particular, if you want to drill down into markets, I think it's driven primarily by employment, right? Quality of life. If you look at our stuff in Utah, right? Salt Lake is one of the best assets out there.
Yeah.
Right? Goldman's gonna move out of a bunch of space. So
you just signed some leases there.
We got people lined up to go in and basically fill that space because the quality of life out there. Now we bought out there. The Mormon Church controls 80% of that market. Right?
Is it that much?
I would argue yes.
I'm surprised it's that little.
Wow.
I would. Yeah. It's a good question because it doesn't necessarily have to be just the church, right? It can be
church affiliated
offshoots. Yeah, sure, of course.
And that's what a lot of they do. That's like when the Catholic Church was buying stuff all around.
Oh yeah, of course.
New York. You know, you look at everything that's owned here. It could be the Friars, it could be the Sisters, it could be, you know,
now they're offloading
the church.
Yeah.
They're trying to get that all things new concept going to redo St. Pat's at $1 billion, right? So, but anyway, my point is that as you look at the markets, right, that market, the quality of life out there. I had one of my analysts come to me 6 years ago. She's like, "Hey, can I move to our Utah office?" So we don't have a Utah office. We just own real estate out there because we own several buildings out there. And I'm like, "Why?" And she's like, "Oh, just the outdoors, the you know, just to have that quality of life, to do whatever, the education. I want to get my master's, you know."
So top markets right now for you guys.
Top markets, I would tell you from a leasing perspective, or from
I would say both from an investment perspective and from a leasing perspective.
So let's go leasing wise. It's remained what I'd call the ones you would imagine, right?
Yeah.
So
Sunbelt.
New York, Texas, Sunbelt, Chicago, which shocks everybody.
Very
surprising outlier.
I would tell you Utah, Phoenix, and then if you look at from an investment, very similar unless it's opportunistic money. It's opportunistic money. We're going to look at the basically the markets that have just been hammered, and that's Seattle, San Francisco, LA. Can't get into New York anymore. Boston still has some challenges and some issues.
So are you guys from an acquisition side looking at some of these markets?
Yeah.
I got to ask, the asset that you mentioned in Kansas, where you had a ton of, that was an office asset, right? That was the corporate,
mixed use,
right? So although
retail.
you're a net seller there, I don't know, maybe you aren't on the whole market, but like you're selling there, the demand is clearly huge for that kind of asset. I think you said like 37 confis and 17 tours.
And 17 tours. Yeah.
That's a lot for a very small market.
Oh, yeah.
Definitely a secondary market.
Right.
So like when you look at something like that, what's the inner signaling?
Well, so some of the best performing markets have been there, right? Even on an industrial wise. I mean, the growth of industrial rents and sort of what I call middle America, the flyover states, has been amazing, right? Now it's a combination of things, right? Lack of product, lack of supply, and the need for it, right? As you do distribution more and more, you just can't shoot all the way across, right? Not using rail, you're using, highways. So anyway, that is in the Walmart factor, obviously. They're in middle America, right? And they're now trying to compete against Amazon to deliver quicker than Amazon. So those markets are driven by a lot of that. But if you go and look, what's KBS has done a lot of over the years, which was hard for me to come in as from my Clarion days, because they were always focused on large MSAs, right? Large markets in the office side. Here at KBS, they've always drilled down into sort of the dynamics of each individual marketplace. So if you go up to a place like Leawood, Kansas, or even downtown Kansas City, there's tons of wealth there. There's tons of entrepreneurialism. There's a need for a high quality office. So what they would do is they'd go in those markets and they'd buy the best product that was there. And that is what has resulted in, even during COVID, the retail suffered at Park Place, but the office stayed, 90%. I think the lowest it ever got was 90 from 100. And it was all institutional type tenants.
The news is important. But if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
Will KBS always primarily stick to office? I know you're in other spaces too.
So we've been so successful in the industrial multifamily development that I would tell you no. We're not going to stay solely in office because those opportunities, as our people have learned that business, right? I think any knucklehead, when I used to help teach at Hopkins, right, in the real estate school, I can tell you I can make any number look as good as I wanted to look. Garbage in, garbage out, right? So any knucklehead could go buy something, right? Because you just owe money if you have so much money, but you got to be able to operate it. So as these asset managers have learned to operate these and are killing it for us, it's now they understand what drives it and what needs to be happened. So I think now is the perfect time for us to segue, not all the way, obviously. I mean, I think
dip your
honestly,
toes, start going more into these other product types.
I would say 60, 65% remains office,
Yeah.
and then increase from the 20% of other product type into a 35%.
Understood.
Yeah.
Let's talk about asset management because you just went there. I think what obviously there's a lot of things happening right now that owners have to do to attract tenants, right? Particularly in the office space.
It's getting even crazier.
I'm sure. So tell us what it is KBS has to do to attract tenants right now.
So Accenture Tower, one of the ones I talked about, is a great example. So COVID happens, the world's coming to an end. Everybody's like, we aren't going to live another month, right?
Mm-hmm.
We're all dying. Contractors were dying to do work. Business were dying to do work. We went in and spent $6.5 million, and people said we were crazy, and we created a speakeasy coffee lounge that turns into a bar after lunchtime.
Yeah.
That has an outdoor terrace.
Do you
fire
think
pits.
the speakeasies are overdone a little bit right now? I feel like every CVS now has
employees
a speakeasy.
love drinking.
Dude, they love drinking. That's true.
It is. In particular, when you're sitting on a transportation hub and you're getting on a train. So you go down there at 4:00. Well, quitting time's 5, but that's okay. But we're collaborating. We're all sitting around.
I'll tell you
collaboration.
I'll tell you one very quick and funny anecdote. We're looking at an office building, and it's very like trade focused. And so we're talking to this group of people, and we're trying to gauge what kind of amenities they need. And we said, all right, well, what if we, give you guys a shared conferencing space and it's got like these things for your job? And the woman just kind of looks at us and she goes, what about a bar?
Everyone's like sold.
And we're like, well, sure, we'll have a bar. She's like, that would be great. A bar and like maybe an area where we can get together in the bar and drink. I was like, you just want a bar? All right, that's fine.
Climate controlled wine lockers, right? So you have guys and gals who are bringing their wine in, $1,000 bottles of French Bordeaux's, and they're keeping them there to, entertain or do whatever.
So you're amenitizing it much more.
Amenitizing it in, by the way, not just the cookie cutter stuff, conference centers, but everybody has those. But then can you take it to the next level, right? We've done podcast rooms.
Yeah.
Man. We were talking about this.
Podcast room.
Well, we were talking about this, right?
Yeah.
Like
I see it in some multifamily too now.
Right. Because
it just means more competition.
To work from home. Right? I mean, come on. You guys are in the league of your own. It's competition. Come on.
Thank you, Mark.
You're welcome. You're welcome. No, I think anyway. But really, when you look at it, it's not as easy done as people think. Right? You look at all the sound attenuation, everything else that has to happen in it, and apartment buildings we were doing it, but now it's like everybody needs to go back to work.
Right.
So our,
it's funny, right? The ones we have right now, so you got empty amenity space. You got all these golf simulators and bowling alleys. No one's using it.
That are or self dog grooming because everybody was adopting dogs. So we were like, quick, let's go put in these dog bathing rooms. Let's get rid of the nail salon in there. And let's go do dog grooming. So we have dog grooming in our multifamily stuff. So you can go down and wash your dog. Yeah. All the supplies are there, little dryers.
I hate to cut you off, but this is something that's really cool that you guys do that I saw that you're doing beehives.
Oh, yeah.
In some of your office buildings.
You got to touch on that.
Yeah.
So
not in.
So crazy idea.
Inside would
just to be clear,
it's
all
not inside. So we have it all over the country.
Yeah.
And so
on rooftops
or if we have an office park that's, call it 3-4 stories, like we have up in New Jersey, or we had up in Fairfax County, out in Tyson's Corner.
So you bring in third parties to operate these beehives, or you bring in your own bees?
Maybe Mark's tending to them himself anytime he's around.
First of all, I'm highly allergic, but to bee stings. But what you learn is these bees don't sting you.
Yeah,
right? So you go there and they literally can cover your whole entire hand.
They say that, but
honeybees
people still wear the whole suit.
If you watch, because it looks legit, looks more legit.
So while I was having coffee before coming over here, I think I saw like 4 of my beehive operators in the coffee shop across the street. So they come over, they're real just great jeans and just they could care less. They're not wearing hoods or anything. So what we do is we have them. So what we realized is that it was a cool little thing for employees to take part in. So they get tours.
I think it's very cool.
Every other week they come up and they go up there and they're pulling out these massive trays and you're seeing all the honeycomb and then they harvest it. And so for example, we just did this in our building in Arlington last fall.
Who gets it? Who gets the big?
So we had 785 tenants. We harvested 1,000 jars.
So cool.
So everybody has a jar of honey. And oh, by the way, hey, what's the best way to cure seasonal allergies?
Totally. Local honey.
People don't even know local honey, right? So it's like this one lady wrote us this long letter saying she was a PhD, and she's like, this is unbelievable. I started giving this to my daughter, and the doctor's like, yeah, that's what you got to make sure it's from where you live and reside. Yeah. Because that's the best way to get all of that.
It's a really smart move.
Yeah.
Just
here's the only issue, right? So we have restaurants. And then I said to the restaurants, I'm like, oh, well, you're a barbecue place. Let's, cornbread, let's put the honey on there. That's a great idea. They were all excited. And then they're like, the health department says no, because it's not from a commercial.
Right.
Yeah. So anyway, but yeah. So it's
have you thought about farms, or not farms, but what community?
You're gonna get into the farms.
Yeah,
community farms.
That's right.
Well, you're gonna see some of those
green
defunct,
roofs, but we're not growing on the roofs. We're not growing tomatoes or peppers.
Some of those defunct office buildings are going to become vertical beehives.
Marijuana plants.
Yeah, that's the next frontier.
That's right.
So you're fully amenitizing these buildings much more.
Correct. It's much more. By the way, much more sophisticated.
Mm-hmm.
I think it's a better word because, like I said, a simple, everybody did conference room check, rooftop check. Okay, but on the rooftop, let's have, we have disco lights on one and karaoke. And kegs. So
that's
people go over there.
Alex's favorite thing is karaoke.
So you can go up there and do karaoke.
What's your
with
karaoke
your
song?
I don't know. I know yours is that Chapel Roan song.
Yeah, what was the song you were asking about before?
I got to tell you,
you gave us a 5-minute grilling.
It's in my head, and I can't get it out of my head.
I'll take you out for karaoke.
What would your karaoke?
Yeah, he wanted my daughter to call my daughter.
Easy, Mark. That's people get the wrong impression.
Exactly. You're a lot younger than me. Exactly. We won't go there.
I'm a married man. No, because this is like a really popular song for Gen Z, whatever. Okay. What's your karaoke song?
It would have to be something country. Probably good old Hank.
Okay. For the record, mine would be "We Didn't Start the Fire" by Billy Joel. But okay.
Really,
yeah, it's a good song.
That's because he repeats the same lyric a bunch. It's got to be something like that. He was gonna say either that or tequila.
We're digressing so much. Okay, so
anyway,
so
concentrated amenity spaces. You have to be very thoughtful about it.
That's it.
Okay.
And differentiate yourself. And by the way, it also involves around the old that everybody's like, when are you going to stop wearing out this term? Location, location, location. I mean, still real estate's that always has been.
Particularly office, I imagine.
Bingo.
Yeah.
A lot.
So outside of amenitizing office space, which is obviously something that a lot of people are talking about and you guys are definitely doing. No, not yet. What are you guys doing in terms of, here's the other sort of buzzword, AI. Is there an AI involvement here? Yeah,
so we did that with our whole ESG initiative, right? So AI in the office space really evolved. And by the way, multifamily as well. Staging of elevators, elevators that memorize how much floor traffic. So, a good example is when Accenture comes in and they have a big conference going on, the elevators are smart enough to start staging themselves after so many runs to those floors.
Okay.
Right? Where tomorrow they don't have anybody in there, so they're moving all over, right? So elevators have been a big one.
Okay.
I don't know if you ever go into some of these buildings and they're like, okay, what floor are you going to? And you just push that one button and, so it's just, that's been big. And then obviously just trying to control energy costs, right? So the movement of the sun and the placement of the sun, AI has been involved in that forever. Okay. It hasn't been the catchword sexy AI that everybody wants to talk about now. But beyond that, there's not much that has been done. Or creative that I think is going to.
The elevator thing is new to me. That makes a lot of sense.
Oh, really? It's been going on for a while.
I believe it. Yeah.
So, and then obviously, everybody still has to have your good old, let's put charging stations everywhere.
Yeah, for sure.
And that's been problematic per se, because the issue is if you look at the gross vehicle weight of a hybrid car versus a gas car, multiple. Right. And then you got to figure out, you need charging stations.
Oh, is it heavier?
Which aren't like,
I didn't realize that. It's because the batteries. Yeah.
Yeah. So if you're building on DC, all reinforced concrete, you got to be careful of loads.
Interesting.
Right? You can't so we had to stage in one of our buildings chargers on 4 levels as opposed to put them all on the first level.
Interesting. You got to space it out. Yeah.
So
fascinating. I never thought about that. Okay. So let's talk about something separate from your assets, and let's talk about just the greater economy right now a little bit. And I think, there's a lot of things happening right now with where the Fed's going to go with, inflation, with tariffs. Tell us where you think things are going.
Yeah. So
how much of that are you even concerned with?
Yeah, that's a good question.
A lot, depending on what product type I'm investing in.
Okay.
So 16 months, they increased rates 500 basis points, right? So in the last 18 months, they've gone down 100 basis points, right? So dramatic increase. Slow on the recoil. I think the problem, Fed's coming out, I think this week, right? I think there'll be an announcement of they're not going to do anything, right? It's the Fed. So I think I was hoping there'd be something, right? So maybe we get that sign of the scratch of the head or whatever, and you see that they're going to do it next quarter. Because there are people waiting on the sidelines to see if there's going to be one more cut, just to get a little bit more comfort in the office investment side. So I do think, obviously, employment, if you look at long-term employment numbers, okay, you got to remember the spikes of employment during COVID were dramatic, right? Even 12 months ago, we started pushing back up a little bit over 4%. Now we're at 3.8. So, that long-term average has been great, far less than the 4.8. That's the historical average at the 3.
And I didn't even think about it, but you're following employment data
dramatically
nonstop.
Because office,
of course,
right?
It's so directly correlated,
completely. Right. So then you start looking at tariffs. Where do tariffs bother me? Well, obviously inflation just on the Fed on the cutting of the rates. Right. So even long-term inflation, you look at those numbers. So my grandfather was I'm a economics geek, right? Grandfather was chief of economic stabilization for 5 presidents, right? Wrote the 90-day price freeze during the Cuban Missile Crisis when inflation went through the roof. And so I closet huge in economics weirdo. And so you look at all these historical inflationary numbers, right? And for the fact that the Fed came out and said, we're going to have it at 2. You can't. Historical numbers.
It's historically over average, it's 3.5 or something, right?
Bingo, right. So what do you, we just had all these, how long of, 1.5%? You can't come back and say, anyway, my point being is, so employment numbers, you track that, tariffs, concern about inflation on certain things, right? Can we go back to building stuff we need? I don't think that's the end goal of having us basically make everything. We just want fair trade, right? If you're taxing us, we want to be able to tax you, and it's got to be, on a level basis. So I think they ultimately will settle that out. I mean, you could talk about the drugs coming across the border and all that stuff, but I won't get into politics, right? We don't do that here, right? You don't do that here.
We like it.
So
I love it.
Yeah.
This guy.
Honestly, the more controversial, the better for ratings.
Okay.
Ratings? What are we, CNN?
So, ratings. The numbers coming across Canada are, again, living in BC, I got DEA guys as my neighbors, right? And gals. So, they're not concerned about the stuff coming across Canada. There's a concern, but it's nothing like it's coming
I never
South
got
America.
that. Yeah, what's coming
South
through
America is
Canada?
Multiples. I mean, huge. Anyway, my point being is that impact, right, got to closely watch on the industrial standpoint.
Okay.
Right, and distribution standpoint. Because do the ports just get hammered and dramatic impacts there? Remember when we were having a flood of stuff coming and we had ocean liners sitting out.
Backed up. Yeah.
Sitting on both
lines.
coasts. Yeah. Waiting. Some stuff spoiling because they couldn't get into the ports. Right. So are you going to have the reverse? And then our distribution channel is going to be disrupted by that. Right. And so the tariffs, I think you got to watch that side of the game. The smartest thing was what BlackRock did, right?
You read my mind.
I
was obviously they think it's cheap, right? Post the workers union, reaching an agreement, they chime in. They obviously don't think tariff impact is going to be as crazy as we might.
Correct.
And for them, it's
I think that's because of what we just talked about. I think it's ultimately these countries are going to sit there and say, okay, we'll peel back ours. Maybe you slightly increase yours for our stuff, and let's all get along.
Somebody was just talking to me about Trump's art of deal making, the book he wrote, and apparently he's got a quote in there that's like, every time I'm negotiating, he's like, it sounds like I build up this crazy ask, right?
He talks about that in the book.
Yeah. And then, but then he finishes with, but I always end up just back to what I originally wanted. So
I got that book autographed from you.
Yeah, I was like, cool. I think I have to go revisit that book now. Yeah.
During the GFC, we did a deal with him. Yeah, and that's exactly what he did. We developed a project that was going to be for sale condos.
Wait, take a step back. So during the GFC, you did a deal with Donald Trump.
Yeah.
Doral.
And he did something.
He bought Doral. And so we were selling condos. The GFC happened. Stock of product of multifamily product in South Florida was tremendous, condos and everywhere. So they came in and they basically said, it's right on this golf course. He's like, I want that. The hotel expansion makes perfect sense. We meet with him in his office. He offers us like 40 cents on the dollar to 35 cents. You're crazy. Like, here, I got an autograph book for you. Pick a tie out if you want one.
I hear he's very charming.
Very charming.
Yeah.
Very charming. Came in and said, yeah, get a tie, get a book, I'll autograph it for you. You know, so we're having this conversation and we were like, this is crazy. But at the end of the day, you know, did we get what we wanted originally? No. Did he get what he wanted? No. But he got it at a deal.
The art of the deal,
the
man.
art of the deal. And, you know, that's how he's ran life.
Wow.
And that's, I think, it's exactly what's transpiring here. I mean, look at the staff he has. I mean, it's just, it's crazy. His cabinet, it's insane.
I know.
Insane.
Sometimes you need insane for radical change.
So we'll see.
Yeah. Look, we got to wrap up.
No, tell us your general outlook
Before we go.
I think just general outlook.
What are you excited for
in the real estate space right now?
In real estate.
Yeah.
Exciting things in real estate? That's
come on.
An oxymoron. But I would say
better than what you're worried
I think,
about.
again, the opportunity exists for somebody to make a big splash in the office arena.
Okay.
And it's got to be the right product. It's got to be the right. There's been so many mergers going on, right? You look at Bridge Investment Group, you look at Artemis, you know, all being bought by bigger groups, whether that's Barings, Apollo, KKR, you know. So I think there's going to be some of that going on. But I also think a play, if you look at somebody like a Blackstone, right? He even said it, I think, you know, we're at the trough. He said it 3 or 4 months ago. Low office component, and they've done very well with that. But how can you deliver the dividend and continue to deliver a dividend when you're buying industrial at 4 caps? You can't. So if you buy the right office portfolio, the right office mix that's cash flowing, and you have your leverage to bring the debt leverage down, I think there's a lot of opportunity in there.
Okay.
But it's the has and has nots. I mean, you just can't go buy a building in the middle of Harlem that's going to be, you know, and think you're going to make a fortune.
Yeah.
But that's what I think is pretty exciting. And the consolidation, I think, is a big play in real estate because it's a relationship business, and it's now just getting a bigger.
Yeah, we're seeing
who's the biggest balance sheet,
right?
Kind of arrangement,
right?
So,
it's a refreshing sentiment to hear because
there's so much negativity out there.
There's tons, but that's what it always is.
Shows clobbering office,
Well, but you know, you look at
I'm
historical.
the same undying optimist.
But
for the space.
You look at historical returns.
Of course.
I mean, it was second only to industrial for all those periods during know when NCREIF was following it. It's just it's anyway.
Yeah. All right. Well, cool. On that note, thanks so much, Mark. Thanks for joining us.
It was great. Appreciate it.
It was
Thanks
fun.
for hosting.
Absolutely.
Awesome. Glad we didn't have to do this in one of our apartment buildings.